Welcome to today's video where we are going to talk about buy-to-let mortgages, interest only, repayment, what's the best one, what should you pick, and all the details surrounding that. Before we get to it, I just want you to know that I have a kitten. I've purchased a new little kitten and you're going to hear him running around. You're probably going to see him walk past me at some point and he may even jump in my lap because he's a little crazy. No one told me kittens are so playful. But if you see that, don't mind it. I've just allowed him to roam around the house freely. I didn't want to lock him up for YouTube videos and I didn't think it would be fair to do so. So if you hear the little banging in the background, that's my little kitty cat, you know what I'm saying? So let's get straight to the important information. So a friend of mine called me the other day and she is getting married, her and her partner. And they are looking to buy a house together. A buy-to-let to rent out in the meantime, so when they get married they can scoot those tenants out and then move in there themselves. So she's been doing offers, doing lots of property viewings, lots of offers, and then have found a house, got an offer accepted, and now has panicked, doesn't know what to do. And I said, you should speak to your mortgage broker first, ideally. And she says, I have. Well, I actually did get on the phone to this mortgage broker and he's talking about interest only and repayment. And she doesn't know what that is, what it's all about. And she doesn't know which one to choose and asked my advice. So I said, look, I can't advise you on what one you should do because it's down to the deal itself and your broker would give you the best options. But what you can do, I'm so sorry, my kitty is trying to play with my feet. What you can do is check out this video that I'm doing for the subscribers today, for the wonderful subscribers today. See the information, see what you think, and then make a decision then. When we are talking about mortgages, we are talking about loans. They are long-term loans. Sometimes you have a short-term loan, sometimes you can have, which is known as bridging finance, and then sometimes you can have a long-term loan, which is known as a mortgage. Now with a loan, you are borrowing money over a period of time for an agreed amount. So this is what you are doing with a mortgage. Now, a mortgage or property, I should say a property, is probably one of only maybe one or two assets that you can actually buy in full, but only with 25% of money that you have. And then you're borrowing the other 75%, which you still have to pay back. Now, when you are making payments on this loan, there are two ways to do it. The first way is by paying the repayment of the capital as well as paying the interest. The second way is just paying the interest during the term of the loan and then paying the original principal loan or the capital back in full at the very end. There are positive and negatives with both of those ways of paying back mortgages. So let's look at interest rates in a little bit more detail so you can understand exactly what that is. Now, when you take out a loan, right, you have the principal amounts. So say you take out £100,000, for example, right? You've taken out a mortgage, you've got 25%, and then you've put down your 25%, and then you have a loan, which would be 75% of that purchase price. Let's just say, for example, that 75% would be £100,000, right? Now, you would be taking out that £100,000 at a set agreed interest rate. I'm so sorry, I'm talking to you, but I'm heavily distracted because my kitten is on my table and he's not supposed to be on my table. So I gotta get him down. Gotta follow the rules, buddy. Come on. He's gotta follow the rules. And the rules of the house. The rules of the house, darling. Oh, and off he goes. So, you got £100,000, right? And you have, say there's an interest rate of 3% a year on that money that you borrowed. That means you're paying 3% on £100,000 every single month. Okay, now if that amount never changes, it'll be the same amount as you go throughout the entire time because the capital's not going down, and therefore that interest that you pay would always be that 3% on top of always that £100,000, so it allows the amount to stay the same. Of course, if you switch providers, or refinance and switch providers, or your fixed rate ends, or the interest rate can change, of course, but that depends on the circumstance. The moral of the story, in terms of it being an interest rate payment, that you are paying the interest on that principal loan only for the duration of the term, and then you would find the capital at the end. Now, the beauty about interest only mortgage is that they are quite cheap, because you're only paying down the interest. You're not necessarily paying back the capital. With a repayment mortgage, you would be paying down the capital as well as paying down the interest. So say if you did take out a loan for £100,000, during the month, you'd be paying the interest on that loan. So you'd be paying your interest as well as part of that capital back. Now, typically what they do is, if you're going to take out a mortgage and your term is 15 years or 20 years or 30 years, they would take your principal amount, which is the amount you've borrowed, and then divide that by the amount of years that you have to pay, and then that equal payment would be the amount you pay per month. Then they do the same with the interest. Now, the interest on the capital loan would be a set amount, and then you'd be paying that interest as well as the repayment together as one payment, being your repayment amount. For your mortgage. With the mortgage on the repayment, the interest would change because the capital is changing. And when I say it's changing, I mean it's decreasing. So say if you've taken out £100,000 loan on a repayment mortgage, if you're paying £500 a month, as of the capital itself, this is away from the interest. If you're paying £500 a month, then the capital's going down, isn't it? So if your capital's going down, that means the interest amount would change, because you've paid £500 off, so you now owe 99,995 or 99,500, and so the interest on that 99,500 would be different, because it's not going to be the same amount, because when it was 1,000, because the amount's different, right? So that amount does change, and so obviously each payment will be different. And initially your interest will be a lot more than the capital, and then eventually the capital will be the one that outweighs the interest, because the amounts are going down. Now, I like repayment because of this very reason. You are able to pay down your mortgage, and you can see the mortgage going down, and you know that when you come to the end of your term, you don't have to worry about finding a lump sum of money. Whereas with an interest-only mortgage, you actually have to find this money at the end of the term. So home ownership, where you're going to live in the property, a residential homeowner, mortgages where you are doing interest only is not so popular anymore, because homeowners having to find this large amount at the end of the term simply was not happening. And back in 2012 they changed that, so now home ownership usually would have repayment mortgages. Whereas if you're a buy-to-let landlord, you would be offered an interest-only mortgage, because it's seen as an investment, and as well as that, at the end you're going to rely on your capital growth to be able to pay down that money. But there's other various ways you need to be considering that, and we're going to get into that shortly. But the key thing is that with repayment, you are paying down that amount. You can see that the original principal loan that you took out is going down, and therefore it's a bit more peace of mind. You have a lot more peace of mind, right? Whereas with an interest only, you are going to have to find that money. And I think, it's very easy to take out a mortgage on interest only, thinking, I'll think about that in 5 years, 10 years, 15 years, or whatever. But it is something that will really consider serious thought, because capital growth goes up and capital growth goes down. And as well as that, some areas there is no capital growth, so there has to be a plan for that also, right? So these are the things that you need to be thinking about if you are going to get out a mortgage on interest only. Now, just touching on repayment of the capital, if you look at this from a strategic perspective, right? If you have an interest-only mortgage, you're going to take out this loan, right? And you've got that core principal loan that's going to be there. You're going to be paying the interest of that loan. for the duration of the term. So let's just say it's a 10-year, let's just say it's a 20-year mortgage. I'm gonna say 10 years. Let's just say it's a 20-year mortgage. So for 20 years, you're gonna be paying interest on this capital loan. For the banks, that's fantastic, because for the core duration of this loan, you're gonna be paying interest on the whole amount. Whereas with repayment, you'll find that the interest is a lot less, because as you pay down your principal amount, right, it gets smaller and smaller, your interest on that amount will also be getting smaller and smaller. I mean, the interest rate stays the same, but the payment would be smaller because you're paying interest on, say, 50,000 in year 10, whereas with an interest-only mortgage, you'll be still paying interest on a £100,000 loan. So if there is an opportunity for you to do repayment mortgages, I would consider that, because it really does help you to lower the amount of interest you pay. Now, the good thing about repayment mortgages also is if you have age on your side, you can go for a long-term mortgage like 30 years. I've recently seen mortgage brokers talking about 35 years, 40-year mortgages, and they those type of long-term mortgages give you a lot more time to pay down the debt, which means that your monthly amount would be less as well. So I've come across a fantastic illustration on onlinemortgageadvisor.co.uk, and they have a really good illustration about borrowing £200,000 at 3% interest rate and in the amount you would actually pay. So obviously I'm going to show you here, but I'm going to look at it on my phone. If you look at this table, you'll find that the interest-only payments are still the same, just as what I was mentioning before. The payments are still the same because the capital amount hasn't changed. So the interest amount that you pay would naturally not change. And that didn't matter whether it's a 20-year mortgage, a 30-year mortgage, or a 40-year mortgage. And now if you're looking at TAR, TAR means total amount repayable, right? So if you look at the 20-year term interest only mortgage, you're only paying £500 a month, right? But look at the total repayment. So although you would have borrowed £200,000, you would be paying back £319,000, which is quite a lot of money. Whereas with that same mortgage on a repayment, you'd be paying £1,100 a month. So not the 500 on interest, £1,100 a month, and your total repayment is 266. Now look at the difference in that. This is what I was trying to tell y'all. If you pay down your capital, your principal, as well as the interest, then the interest you pay back will be less. This is primarily for home ownership. If you're a buy-to-let landlord, generally you go for interest-only mortgages. But do consider repayment if there's an option to, because the income is just in abundance and it allows you to do so. See what it looks like, see if that works for you, right? Now let's look at 25 years. That's one of the most popular ones. A lot of people get 25-year mortgages. Again, interest rate is still the same. £200,000 over a 25-year term, your interest is still £500. Why? Because the principal amount hasn't changed. So it'll always be £500. What you're going to see the difference in is in your total amount repayable. So look at that. The total amount repayable is £349,000. That's a whole £150,000 more than the amount you took out. Oh, even the mirror had something to say about that. Even the mirror got something to say about that, honey. That's a lot of money. That's a lot of money. Y'all know that's a lot of money. Now, next is looking at the 30-year mortgage. Imagine 30 years on a £200,000 borrowed amount. You are looking at £500 a month on your interest-only mortgage, right? However, look how much you pay on that bad boy. £379,000. Let's just say 380 because it's 379,900 or something. Let's just say £380,000. So you're paying an extra whole £180,000 on top of your £200,000 that you originally took out over that 30-year period of time. That is quite a lot of money, right? That's quite a lot of money. In fact, that's about 2 houses down here. That's 2 houses in Swansea. So y'all can give that money to me. I'll go buy me some houses with that. Looking at that, you can see the difference of just between that 20-year payback, that total payback in 20 years at 319 versus the total payback in 30 years at 380,000. It's a big difference. It's a big difference, right? So it just goes to show 10 years, they obviously going to get another 10 years worth of 3% annual interest. That's 60 grand. Let me see. That's 60 grand. One thing I like about this table is that it allows you to make a clear decision. And I'm going to ask you what your decision is, what mortgage you would go for. Looking at this, what mortgage would you go for at the end? I'm very, very curious. This isn't going to work, is it? Now he's got a toy. He's a little kitty cat. little kitty cat. Looking at this, I'm curious, what would be your decision? What amount would you go for with this mortgage? Because look at this, in 30 years, right, if you took out a 30-year mortgage, age allowing, and you did a repayment mortgage, 30 years, your payments are £843 a month. That is quite close to your interest only mortgage. £300 more, £350 more. That's not bad. That's not bad, right? So, you know, it just goes to show that you want your mortgage broker to present information to you like this. I would want to see a little thing like this, because this will help me navigate what one to go for quite clearly. Personally, it does depend on what the income of the property is, and just keep this in mind, this is a property investing channel, so this is all about property investing. We're talking about buy-to-let mortgages now, right? When it comes to taking out a loan to purchase the rest to purchase the rest of this house that you bought for 25% down, you're taking out your 75% mortgage. This is what we're talking about, right? So now when I'm looking at this, okay, by the way, I forgot to say, look, if you guys are liking this information, if you're liking this channel, hit subscribe to this channel and let me know that you like the content. Participate and do comment down below. Let me know what's going on. Let me know what you're thinking. Let me know information, and I'll be sure to talk to you then. Now, looking at this illustration, it will allow me to make a decision on what amount I need to be going with. What type of mortgage would I be going with, whether it be repayment or interest only in terms of repaying the mortgage. And it would help me make a decision. Things I would look at is, what is the income of the property? How much money is this property going to be making me a month? And that would also steer my decision to what mortgage will be going to. So say, for example, if it's a house that brings in £1,500 a month, and if I was to look at this option right here in this calculator, for me, I personally would then go for the 30-year mortgage, the 30-year repayment mortgage. Why? Because my house is bringing me £1,500 a month, honey. So I can afford £900. Well, 843. I can afford the £843. So I can be paying down this capital, because you remember, you have fixed terms. You could do fixed terms. You could do variable. You could do different type of. Bearing in mind the variable though, with variable mortgages, the interest rate changes. So although when you look at this is based on a 3% mortgage. If you went for a variable mortgage where your interest rate would change with the bank, yeah, I know what I'm talking about, the English bank, the Bank of England, right? Then that number would be changing too. But if you had a fixed only mortgage, right, and it's 3%, then you got, for that duration of that fixed period, with 2 years, 5 years, you would then only be paying that amount. So it just allows you to be able to plan a little bit better. But, you know what the income of the property is that you're looking at, which it will help you steer your decision in what mortgage to go with what mortgage to go for, as well as that your mortgage broker should advise you that your income for the property needs to be at least 1.5 or 2 times that mortgage payment. So if the mortgage payment is £500 a month, your mortgage lenders are going to want to see that that property is making at least around that £1,000 mark. You would have to make sure that the rental income can cover the mortgage and some. ask you a question. Say if you had an income of £2,000 a month from a particular property, what mortgage would you go for? And tell me why and let me know down below. I'm very curious to see what decision you'll make and how you would make your decisions. I hope you found this video informative. I hope you found it interesting, and I hope it answered any questions you would have had about mortgages. I am going to do another video on the types of mortgages in terms of the terms and what that looks like, the variable, whether it's variable mortgages, whether it's fixed mortgages, and all the other details that goes into mortgages that I have not covered in this video. If you definitely want to see that, let me know down below. But if you don't, and I don't hear from y'all, I'll take it you don't want to see it, and then I won't do it, okay? But thank you so much for watching this video. I hope you found it interesting. Make sure y'all subscribe, and I'll see you in another video. Take care. Bye.